Good afternoon, everybody. So welcome here to this session organized by the Financial Stability Institute on current regulatory issues. As you know very well, since the beginning of the crisis, 20 years ago or something, there have been a considerable regulatory reform effort by global standard setters, basically with the purpose of achieving two objectives. First one, obviously, is to reduce the probability of severe financial crisis moving forward, and second, trying to reduce the real cost of those financial crises should they occur. You know very well that those reforms span over a wide variety of dimensions and issues, covering prudential requirements of different sorts of financial intermediaries, consumer protection issues, as well as crisis management preparation. So it's clear that this regulatory package is a result of a very important cooperation effort in which national authorities participating in different fora and committees in different areas of expertise have made a very important contribution. So in that context, of course, we are fortunate to have been able to organize this session, as has been done in the last few years, basically to take a stock of what is the current situation on this global regulatory reform journey, and also to discuss what are we heading to, what are the pending aspects in which standard setters are now working. And for that purpose, I think we are lucky to have here the heads of the secretariats of all committees, all standard setters actually based here in Basel. So let me introduce them, although they don't need much presentation. First, we have Svein Andresen, and he's the Secretary General of the Financial Stability Board. Bill Coen, Secretary General of the Basel Committee on Banking Supervision. Yoshihiro Kawai, Secretary General of the International Association of Insurance Supervisors. Morten Bech, he's the head of the Secretary of the Committee on Payments and Market Infrastructures. And David Walker, Secretary General of the International Association of Deposit Insurers.
So I'm going to speak to progress in implementing the reforms that have been put in place since this financial crisis. And then I'm going to talk about some work the FSB is doing to address other emerging vulnerabilities. And to start with where you ended up, Fernando, how far along have we come with these financial reforms? I think we are now seeing that the reforms agreed since this crisis are well on the way to generating a more resilient financial systems. Look at the largest banks. They are considerably stronger, they are more liquid, and they are less complex, turning less complex. Sources of finance are increasingly diversified, and the infrastructure that underpins financial markets is more robust. And if you look at episodes of volatility in the last numbers of years, we have seen that the system is demonstrating an ability to dampen shocks rather than to amplify them. And all of this has come into place over the last 6 or 7 years in an environment in which credit flows to the real economy have continued, unlike what the financial sector have raised as significant concerns. And credit is now growing robustly in all major economies, with the cost of financing remaining low. So all of this is good news, but it's not all good news. Some elements of reform remain to be finalized, and Basel III is one of those that Bill will speak to a little later. And there's still much to be done to achieve a full and consistent implementation of some of these reforms. And there are a number of areas that merit ongoing attention, including the effects of these reforms on liquidity in fixed income markets is something that many speak about. The impacts on emerging and developing economies of reforms being implemented elsewhere, and risks to fragmentation of the system. And there's no doubt that there is a degree of reform fatigue setting in, and with that, I think there's a danger of some of these efforts stumbling on the finish line. And that would be a mistake in the judgment of FSB members. It would leave vulnerabilities unaddressed, and it is more likely to lead to more fragmentation in the system rather than less. As you know, there have been very many reforms introduced in recent years, and while all of those major reforms have had an ex-ante impact assessment, it is important to assess whether these reforms are individually and together achieving their intended outcomes. And where that is not the case, the reforms should be adjusted. And with implementation now well progressed, it's becoming possible to begin to make these kinds of assessments. And last year, working with the standard setting bodies, the FSB began to develop a process, a framework that sets out processes and analytical tools to undertake post-implementation evaluation of the effects of the major financial reforms. And that framework is now finished, and the FSB will be presenting that to the G20 summit in Hamburg in a couple of weeks' time. The goal of that framework is to guide analysis of whether reforms are achieving their intended outcomes, whether they are working together as intended, and if there are material unintended consequences, to make adjustments or to discuss adjustments that would alleviate them without weakening the resilience objectives that these reforms have had. This is a challenging but necessary undertaking, and we will start gradually and make adjustments and improvements over time as experience and data improve. Let me speak to progress of derivatives reforms and shadow banking reforms in order. With regard to the effects and effectiveness of derivatives reforms, you may recall that the objectives here were to have introduced central clearing of standardized derivatives, margining of uncleared derivatives, platform trading to increase transparency, and reporting of derivatives transactions to trade repositories. And we find that there have been significantly higher levels of central clearing and collateralization of uncleared trade since the crisis. Platform trading is expanding, improving transparency and processing efficiency in these markets. And trade reporting is increasing the transparency to authorities of derivatives markets, although here there are legal barriers, lack of data harmonization, and other things that challenge the usefulness of these data. Nonetheless, the FSB's judgment is that these reforms have meaningfully reduced risks, systemic risks in the global financial system. There are some concerns that clearing member banks are not offering all clients clearing services, and that the Basel III leverage ratio may have be amongst one of the causes of this. And the FSB, together with the standard setting bodies, will this year undertake an assessment of that issue, and it will be the first to be addressed in our case under the policy evaluation framework that I mentioned earlier. More generally, the success of these derivatives reforms depend critically on getting the framework around CCP resilience, recovery, and resolvability right. Central counterparties have become hugely more important nodes in the financial system. And work in this area has been the focus for CPMI, IOSCO, and the FSB over a little bit more than the last year. And in a couple of weeks' time, guidance documents on resilience, recovery, and resolvability will be published by these three bodies. There remains a piece of work to be done for CCPs, and that is assessing whether there is a need for additional financial resources to be held either by clearing members or CCPs themselves to enable orderly resolution of CCPs should material difficulties appear. Let me turn to shadow banking. Shadow banking, you will recall, was a major contributor to this crisis, and we have now reviewed whether the policies that have been put in place since the financial crisis have dampened the risks in this area, and whether the monitoring put in place is adequate to capture and address the risks that are material. And we have found that reforms in this area have significantly reduced the types of toxic shadow banking activity that were an issue ahead of the crisis. And other more constructive forms of non-bank credit intermediation, such as money markets and others, have been subject to reforms that lessen risks and enhance their positive aspects. But one of the things that has happened is that credit intermediation via asset management entities has grown very rapidly since the crisis. And while this provides welcome diversity and reduced reliance on banking, it introduces significant liquidity transformation risk where those asset management entities offer funds in the form of open-ended funds with daily redemption. So mismatch between fixed income assets, which tend to be relatively liquid, and highly frequent redemption. The FSB published recommendations to address these vulnerabilities in January this year, and IOSCO, which is not present here, is presently operationalizing these recommendations and will shortly issue a consultation document setting out strengthened liquidity and redemption risk management practices for open-ended funds. There's one piece of unfinished policy in this area, and that is Basel Committee recommendations to address banks' step-in risk for unconsolidated entities or entities to which the bank might have reputational exposure. At this stage, the FSB has not identified any other risks to global financial stability from shadow banking that merits regulatory initiatives at global level. But this is an area in which things change rapidly, and we are all familiar with shadow banking problems in some jurisdictions, and authorities need to be vigilant. The main recommendations coming out of this work is that agreed policies in this area need to be implemented, and monitoring at global and national levels need to be strengthened. Another important piece of reform has been to resolution regimes. And reforms in this area are progressing but unevenly. All the home countries of globally systemically important banks now have resolution regimes that meet the powers and tools set out in the key attributes of effective resolution regimes, which were agreed some years ago. And most of the globally systemic important banks are on course to meet the TLAC requirements, the first phase of those, well ahead of them taking effect in January 2019. But when it comes to cross-border resolution issues, and those are all relevant for globally systemically important banks, there are still many issues to be addressed, including cross-border cooperation arrangements amongst authorities that are rooted in law, as well as implementation of protocols that prevent early termination of financial contracts. We are releasing additional guidance relevant to resolution shortly. That pertains to internal TLAC, which are the loss absorbing resources committed by a parent bank to materials of subsidiaries that are not themselves resolution entities. And we are also publishing guidance on continuity of access to financial market infrastructure for firms in resolution. Let me turn at the end to other areas in which the G20 has requested the FSB lead work on. One of those is reducing misconduct risks in financial markets. And here we've had an action plan in the FSB membership since 2015. And by the Hamburg Summit this July, we will report on the actions taken and the recommendations to be made. And those fall under the three headings you see on this slide. Under the first one, we will issue supplementary guidance on compensation policies, introducing incentives to reduce misconduct risk. And under this heading, we continue to work on responsibility mapping for individual accountability for misconduct, and on what is called rolling bad apples, what sort of diligence improvements and information exchange needs to take place amongst institutions so that those that have been responsible for misconduct in one institution isn't easily employed in another and causing the same problems there. With regard to the robustness of market structures and conduct standards, you will have seen that the BIS Markets Committee and Global Foreign Exchange Committees have reduced the code of conduct on FX markets. And progress is also being made on addressing manipulation risks in major benchmarks, interest-based benchmarks, where just these days new benchmarks for derivatives trade in the form of risk-free rates have been identified and agreed amongst major participants. And last, under actions directed at authorities' capacity to address misconduct risk, IOSCO is setting out recommendations on tools and approaches for wholesale market conduct regulation. Let me talk about correspondent banking for a minute. Correspondent banking relationships have been reduced for quite a number of emerging and developing economies in the last numbers of years, and this is threatening the ability of some of those countries to access the international financial system, and it risks driving financial flows underground rather than through major institutions. And there is an action plan here involving the IMF, the World Bank, the FATF, CPMI, other bodies. And we will report on the actions that have happened to alleviate this problem or understand it better. And that includes clarifications by the Financial Action Task Force and by the Basel Committee on due diligence, as well as quite significant progress in capacity building cooperation involving the international financial institutions. My last 2 points is to talk briefly about work on FinTech and cyber resilience. We have been asked to assess the supervisory and regulatory issues that merit attention from a financial stability perspective from FinTech. All of the bodies at this table are, one way or the other, involved in assessments of FinTech applications and what they might mean. And this report pulls together high-level analysis in a financial stability framework and sets out issues that authorities need to consider going forward. There are no surprises there. One needs to assess the regulatory perimeter. One needs to build supervisory and regulatory capacity and expertise. There needs to be attention to cross-border legal and regulatory issues that will have a bearing on FinTech's spread. And of course, there are going to be operational dependencies coming out of FinTech, and cyber risks are a relevant consideration in this area. There's a lot of work on cyber resilience. You will hear more about it. And we will undertake a stock take of what exists in regulatory and supervisory guidance for the G20 by October this year. At the very last, let me mention that a task force on climate-related financial disclosures, which the FSB convened last year to develop voluntary disclosure formats for companies to provide better climate-related exposures, will be published in July and delivered to the G20 summit in Hamburg. Thank you very much.
Good afternoon, everyone. It was 1 short year ago, I sat in this very seat and I spoke to many of you, and I said, the Basel Committee has made very good progress. We continue to make good progress. I expect we'll continue to make good progress, and that I expected that we would finish our reforms by the end of last year. I was right. I was right in that we made good progress, and I was right in a sense that we finished our work. We did. The technical work to finalize the Basel III revisions have been completed. More about that in a second. Let me give you a glimpse of what we have done over the course of the last year. We finalized rules on securitization. There's a new accounting standard coming into effect next year. That's IFRS 9. And we published some transitional guidance to make sure that there's a reasonable transition, if needed, for banks that will be adopting IFRS 9. Svein mentioned a moment ago, total loss absorbing capacity, TLAC holdings, that's required for the global systemically important banks. The Basel Committee published guidance on, if you're a bank that holds TLAC, how do you treat it for capital purposes? We've produced a raft of FAQs, frequently asked questions, on new standards that we've published over the course of the last couple of years, and now that are starting to come into effect. For example, leverage ratio, the Pillar 3 disclosures, the large exposure regime, the net stable funding ratio, and the like. I'll turn to this in a minute or two. Our work on implementation. We've assessed many Basel Committee countries on their adoption of the Basel III rules. Again, more on that in a second. So the big question, what have we done to finalize Basel III, or what remains? And yes, discussions continue pretty much about one single factor. And if you think about what, it's very much in the financial press these days. It's even in the popular press, and that's the issue of a capital floor. But one would get the impression that that's the only thing that's part of this package. I like to refer to this package as it's almost like a jigsaw. There are many parts, and we have pretty much finished. Not pretty much. We have finished the work on these other parts, and that includes the standardized approach for credit risk. This is the predominant capital treatment for most banks around the world. They use the standardized approach, not the modeled approach. But we've also made some changes to the modeled approaches. And so that work has been completed. Operational risk. At present, as part of Basel II, there is what we call the advanced measurement approaches. That's the modeled approaches for calculating or estimating operational risk. The modeled approach has been removed and it's being replaced with a standardized approach. Again, we finished the work on the standardized approach. If you're one of the 30 global systemically important banks, you're required to hold, there are minimum thresholds, but if you're a GSIB, as we like to call them, you have to hold a little bit more, a capital surcharge. Right now, there is a capital surcharge in place for the GSIBs, but it's a risk-based capital surcharge. We've added to that a leverage ratio surcharge to bring some symmetry to the GSIB framework. And now the output floor. The subject of great debate these days. Think of it in two ways. There's the design of the floor, and there's the calibration of the floor. It's the calibration of the floor that's that's a thorny issue. I'm going to say a few words about the floor. And so what is all this talk about a capital floor? Really, if you think of it this way, when a bank calculates its regulatory capital, they can use a standardized approach, or they can use their internal models for regulatory capital purposes. And the question is this: how much of a benefit should a bank get by using its models? Think of it another way as a floor. So if your capital under the standardized approach comes to 100, well, depending on where we set the floor, let's say we set it at 70%. Well, then your capital as calculated by your models can't fall below 70%. So in other words, a bank using its models, it gets a 30% benefit. You can think of it that way. If we set the floor at 75%, it gets a 25% benefit. And that's really the crux of the discussion right now. We have made progress. We have finalized the design of the floor. There are different ways you can do this. You can be very granular and construct a floor based on asset classes or based on risk types, credit risk, market risk, operational risk. Or you can do it in a simple way, and we call that the aggregate approach. And that's the approach that we've adopted. So we've got the design of the floor. It's the calibration that remains. When we consulted on this last year, we said it could range anywhere from 60 to 90. So the good news is we've made progress. We've narrowed the range. And keep in mind, there is already a floor in place as part of Basel II. The Basel Committee even reaffirmed the existence of a floor in 2009. So there should be a floor in place at the moment, and that floor was set at 80%. What is the next step? For a package of revisions as weighty as this, and bear in mind the previous slide, there's all the work we've done in the standardized approach and IRB and operational risk and the other things. This is something that requires approval from our governing body. We report to the central bank governors and the heads of supervision. So the next step would be for that body to approve the package. When confronted with a difficult, impactful package of reforms such as this, how have we handled it in the past? Well, think about the implementation date for something as big as this. And what's going to happen after we finish the reforms? The next step in the process is it goes to the country level. This all has to be transposed into national legislation or rule writing, and for something like this, that's going to take some time. So, at a minimum, my estimate is the implementation date for these reforms is probably 2020, 2021, maybe even beyond that. We also have to think about transitional arrangements, and this is the approach we took with Basel III back in 2010. We adopted much higher capital levels, and in some jurisdictions and for some banks, it required a lot of capital that needed to be raised. So we had a long phase-in of the new requirements. And then for something that's new, or something that will have quite an impact in some jurisdictions or for some banks, there's a review clause. How do we know we got it right? All the work we've done over the past couple of years with the leverage ratio, the liquidity standards, this is all new stuff. And I think as a sense of humility, we recognize that, let's go back and make sure the standards are behaving as expected. So that's the floor. When I think about the Basel Committee's work, we have the policy work, which Basel III falls under. When I talk to banks and the trade associations, they're always quite relieved when I say, there's really not so much more in our policy pipeline. Of course, we've done a lot. Some people say too much. I think just enough, and we're about to finish, I think, what remains. There are a few things that remain in our policy pipeline. The treatment of sovereign exposures. I would put this in the same category as our remaining Basel III work. We had an expert group that looked at the different issues that arise when you think about a bank's holdings or a bank's exposures to a sovereign. It's not as simple as the capital treatment for the holding of a sovereign bond. You have to define what's meant by a sovereign. There's public sector entities, multilateral development banks. So it's a little bit more complicated than it looks. There are different proposals. The current treatment in many jurisdictions is to provide a 0% risk weight. There could always be a non-0% risk weight. There could be a large exposures approach, like a concentration of sovereigns on your balance sheet would warrant a different treatment. So there are a number of proposals that the expert group has come up with, but something, again, like the other things that I just mentioned with Basel III, this is an impactful, a very important topic, and that's something that would require the discussion, review of our governing body, the central bank governors and heads of supervision. Simplifying the market risk rules. We finalized the trading book rules last year. People refer to it as the fundamental review of the trading book, FRTB. I'm not content. I think the Basel Committee is not content with where we left off there. I think the rules are still way too complex, and I think there are ways that we could simplify the rules. I think we will likely consult in the next week or so on a simpler set of rules. So as much as everyone in the Basel Committee, myself included, were relieved to finally have finished that work January of 2016, we're not quite finished because I think there are ways that we can improve that set of standards. Corporate governance and culture, this is something that's not going to go away from our agenda. We've have promoted strong governance standards since 1999. And what happens is we produce guidelines, and then there's a reflection 5 or 6 years later. We see same risks, but they manifest themselves, or the same misbehavior, but maybe they manifest themselves in different ways, and we update our guidance. So this is something we'll continue to look at, maybe not so much from a policy perspective, but certainly from a bank supervision perspective. And then there's finally FinTech and cyber risk. Svein mentioned a moment ago, this is a busy space. The Basel Committee, the other standard-setting bodies, this is a really busy space that people are looking at. The one thing I will note about the Basel Committee's work on disruptive technology or innovative technology and the impact on banks and bank strategies, and then, of course, cyber risk, the one thing that we will do from the Basel Committee is to make sure that when we look at these topics, to make sure we're looking at just from a bank perspective or just from a bank supervisory perspective, because it is a crowded area, but that's the one area, excuse me, where we can add value. So I said a moment ago, I think of our work along a few different dimensions. One of them is certainly policy. The other is supervision and implementation. And we are the Basel Committee on Bank Supervision. I alluded a moment ago to, we've developed all these new standards over the course of the last few years. The liquidity standards, the leverage ratio, and it is important to look at these. How are they behaving in practice? Are there unintended consequences? We hear about that quite a bit. Very often they are actually intended consequences. But any discussion around this has to be data-driven, evidence-based. But we are looking at the impact of the new standards. We're looking at how the new standards change bank behavior. Does it lead to regulatory arbitrage? We're already seeing some evidence of that. So that's something that we are looking very closely at. Are there opportunities to arbitrage the rules? How are bank behavior changing? How does it result in different strategy, different performance among banks? Implementation of the post-crisis reforms. This is a relatively new line of business, if you want to put it that way, of the Basel Committee. We call this the Regulatory Consistency Assessment Program. We, as of last year, we have now assessed all Basel Committee member countries, and the idea is to look at the Basel standard and how do the local standards or the jurisdictional standards compare with Basel? And are there deviations? If there are, how are they material? And an important part of this process is publishing the results, which we do. And I expect in the next week or so, we've got reviews of the EU, China, and the United States that we'll be publishing. That was a review of their liquidity coverage ratio standard. But this is a relatively new line of work for us, but we take this very seriously, and I think it has had tremendous effects so far. We really have shifted focus. So much of what we do, the Basel Committee, so much of what we do that's noted in the press has to do with Basel III. And that's really the policy side of things. But we started out life about 30 years ago as a group of supervisors, sharing information, talking about emerging risks that are risks emerging in one jurisdiction, how are they being handled, how might they manifest themselves in other regions. And so we have certainly made that slow turn toward greater emphasis on supervision, and I expect we will continue to do that. So, Fernando, thank you very much.
Thank you.
Yoshi, over to you.
Yeah, thank you. So, good afternoon, everybody. Just one sentence for IAIS. I assume that many of you know the IAIS. IAIS is the insurance version of BCBS, so Bill's group. Of course, our members do not feel happy to refer to banking sector, but anyway, we are standard setter of insurance sector as the Basel Committee standard setter of banking sector. So just step back what we have achieved after the financial crisis. And Svein mentioned very clearly that now almost all policy framework has completed, and as Bill mentioned, also Basel Committee policy framework is almost completed. But there are some key industry, financial industry, which we have not yet developed key policy framework after crisis, and one of which is our industry, insurance. Financial crisis, AIG crisis, demonstrate that the insurance industry or insurance companies are very much linked with the financial sector or financial system. And IAIS, our association, work extremely hard to create more globally consistent, strong standards. So my message today is two issues that I cover: insurance capital standards and global systemically important insurance and insurance activities, what we did and what we are going to do in coming years. So first, global insurance capital standards. This is, again, reference to the banking. It's like Basel III in insurance version. So we are going to create insurance global capital standards within a few years. We have already developed so-called BCR, Basic Capital Standard. It's like Basel I in the insurance version, and higher loss absorbency. This is a GSII, Global Systemically Important Insurance Capital Add-on. So we have developed those capital framework 2014, 2015. What we are aiming for now is global risk-based capital standards which apply internationally active insurance companies. Next month, July, we are going to issue version 1, but this is not really standard. This is more report or field test for insurance companies. And 2019, in 2-year time, we are going to issue version 2.0 of ICS, Insurance Capital Standard. This is global capital standards for regulatory consequences, i.e. for implementation. So that's all internationally active insurance companies should comply with these standards. So our ultimate goal of this ICS, Insurance Capital Standards journey, is to achieve substantially the same outcome across the jurisdictions. In other words, if insurance companies, globally active insurance companies, headquarters located in country A, and that company shifted headquarters to company B, but capital requirement of those companies are substantially the same. I don't know Basel III will achieve this goal, but it's an extremely challenging goal to achieve this very much globally consistent capital standards. This is our ultimate goal. Our version 2, 2019, we are not sure that we can achieve this ultimate goal, but we are moving towards that ultimate goal to create our insurance capital standards. Key challenge of this insurance version of this capital standards is valuation, valuation, valuation. Some countries, like particularly in the global scale, US have so-called gap-based valuation, and other countries like Europe or some other jurisdictions, so-called market-based valuation system. As you know, that market-based valuation is very different from gap-based valuation. So the challenge for insurance supervisors is to make a convergence, at least make a consistent or reconcilable valuation system between the two. But there is some positive development. We have now field testing of more than 50 internationally active companies. Not only, for example, US companies test by gap-based or gap-adjusted valuation, but also market-based valuation. And vice versa for insurance companies in Europe, they have to test not only their market-based valuation, adjusted one, but also gap-based valuation one. And we realized that the significant challenge is there, but we realized that there is a room for convergence. And key challenge of this valuation is simply put, is so-called discount rate or yield curve. Life insurance industry like annuities or long-term, they have even 30, 40, 50 years product, and discount rate, even slight change of discount rate have a huge difference of valuation of liabilities. And we identify this is the challenge that we have to overcome in next few years. And we are very much optimistic and way to converge those issues. So in short, 2019, we are going to achieve more converged valuation system. It might not be identical valuation but consistent valuation globally. And then version 2.0 insurance capital standard will be ready to implement. So gradual implementation will start 2020. Briefly, our journey for this global systemically important insurance framework. We have already developed closely collaboration with Svein's Financial Stability Board assessment. How do we assess global systemically important companies, and also designation, identification of the companies. Now we identify 9 insurance companies in the world as systemically relevant. And in addition, we have policy measures developed to apply to those companies. Recovery and resolution plan led by particularly FSB, and the capital add-on and more intense supervisory measures. And now, last year, after 3 years, first we developed 2013, and we improved significantly this assessment methodology, and we designate or identify or review our identification, and again, 9 companies are identified as systemically relevant. And during this exercise, we understand that not only systemically important companies are focused, but also systemically important activities are important to find a solution of this discussion of systemically relevant companies or activities issues. Simply put, to see only part of identified companies and apply to the policy measures is not sufficient. We have to see all market development and identify systemically relevant activities and apply policy measures to those activities is supplementary or complementary to this so-called entity-based approach. So now we are working hard on this activity-based approach in parallel with improvement of entity-based approach, which already have some good foundation. So this is a very brief summary of our time schedule. So as I mentioned, next 2 years we work hard to develop ICS version 2, that truly global capital standards for implementation, and we will achieve this version 2 2019, and implementation starts 2020. In parallel with this development, we are going to work on this enhancement of GSII work, particularly in addition to enhancement of entity-based approach, we introduce activity-based approach, and we conclude this exercise 2019, and we identify systemically important insurance companies with FSB 2020, and policy measures, particularly higher loss absorbency capital add-on, will start 2022. The bottom line of whole our discussion of our reform is taking much more time than banking or general other financial sectors, and we see because insurance is, we have to start from the scratch. Basel have 25 years of history or even longer history of capital, but we have to start capital journey from the scratch after financial crisis, but we are sure to achieve these global capital standards in 2019 and implementation start, and also GSII systemically relevance issue we work hard. Thank you.
Thank you very much, Yoshi. Let's move now to infrastructures. Morten.
Thank you, Fernando, and thank you for the kind invitation to be part of this panel. Good afternoon to all. I appreciate the opportunity to share some details about the current work program of the CPMI, that is the Committee on Payments and Market Infrastructure. I will first briefly introduce the CPMI and then turn to some of the work that we do. So we rarely wonder about infrastructures that underpin our daily lives. When you walk to the BIS from your hotel, you probably did not marvel at the water drainage system here in Basel. We indeed only tend to think about infrastructure when something goes wrong, not when something goes well. So it's perhaps not surprising that many people are not aware of the work of the CPMI. In part, this might also be due to the fact that financial market infrastructures generally weather the financial crisis relatively well. But in short, the CPMI is a global standard setter for financial market infrastructures, promoting their safety and efficiency. One can think of us as plumbers in suits. The committee is currently chaired by Benoit Curé of the ECB. It is hosted here at the BIS, and members are senior officials from 25 central banks. Our key standard is called the Principles for Financial Market Infrastructures, and were developed together with IOSCO. IOSCO is the International Organization of Securities Commissions. Today, I'm going to focus on just 4 key areas that give a broad overview of the work of the CPMI. So it's going to be analyzing new technologies, cooperating on efforts to improve cyber resilience, developing new guidance to enhance the resilience of central counterparties, and monitoring the implementation of standards. We do not do the work on these topics alone. We coordinate with other standard setters, in particular IOSCO, but also the FSB and the other standard setters on this panel. We continuously monitor and analyze technological innovations in order to understand the potential implications for FMIs and financial stabilities. This is not always easy, as payments, clearing, and settlement is a dynamic and constantly evolving business. Let me highlight 2 recent examples. In retail space, consumers around the world are increasingly demanding that payments work like email, instant and 24/7. We have analyzed the emergence of new forms of faster and mobile payment in the 2 recent publications cited on this slide. Another hot area is digital or cryptocurrencies such as Bitcoin, and in particular, the underlying technology known as blockchain and distributed ledgers. This technology appears to hold great promise, but most projects are currently only in the proof of concept phase. The wide-scale use of distributed ledgers in payments, clearing, and settlement is likely some years away, as many technological, legal, and other hurdles will need to be overcome. Nonetheless, central banks have to be prepared for the future and be able to understand new proposals and concepts as they emerge. This is why the CPMI have published an analytical framework for authorities to analyze the impact of distributed ledger technology in payment, clearing, and settlement. All documents are available on the BIS website. As for innovation, there's a lot of interest and concern about cybercrime and attack. The CPMI, again together with IOSCO, responded last year in June by publishing guidance on cyber resilience for FMIs. Our principles for FMIs already cover operational risk in detail, but some elements of cyber risk are different. Cyber attacks can be difficult to identify or fully eradicate, and the breadth of damage difficult to determine. Moreover, there are typically many entry points through which an FMI can be compromised. That makes it harder to play defense. Furthermore, cyber attacks can render some risk management and business continuity arrangement ineffective. For example, if data is corrupted, then an FMI may not be able to calculate its financial exposures accurately. So this guidance covers 8 broad themes as set out in this figure on the slide. Clear and effective governance is at the center. It should involve senior management and the board. Effective resilience not only involve identifying threats and protecting the FMI, but also the ability to detect an intruder and being able to recover if your defenses fail. Complementing these, on the outer circle, an FMI needs to test its processes and systems, be conscious of its threat environment, and it is key to learn from previous incidents and peers with a view to evolve. Importantly, the guidance is not a tick box exercise. It is, we like to think, a coherent framework with each aspect being necessary. Weakness in one area will result in broader weaknesses. For example, if testing is weak, an FMI won't accurately know the quality of its defenses or recovery arrangements. And if detection is poor, then an FMI might have a great response plan that it initiates too late to be useful. A related area is wholesale payment security. You have all probably heard about the February 2016 attempt to steal close to $1 billion from the Central Bank of Bangladesh using fraudulent SWIFT messages. CPMI has set up a dedicated task force. As our chairman noted, it is important that there are effective controls in place throughout the payment process, because the chain is only as strong as its weakest link. The payment chain includes FMIs, but also banks, network providers, and a number of other financial institutions, making this a non-trivial exercise. Since the financial crisis, there's been a concerted push for financial authorities to make over-the-counter derivative markets safer. One aspect of this effort is increasing the use of central counterparties, CCPs, who are the buyer to every seller and the seller to every buyer. CCPs simplify complex networks of derivative exposure, but they also concentrate credit risk, which requires them to have high risk management standards. Since the publication of the PFMI, CPMI and IOSCO has focused on CCP resilience and recovery. And there are final versions of 2 important reports that complement the PFMIs coming out within days. Our work is, as Svein mentioned, closely tied to the FSB-led work on CCP resolution. In addition, the CPMI and IOSCO has been developing a framework for supervisory stress testing, similar to the ones currently carried out for banks, but with important differences that reflect the very different risk profiles. A report on this is due out on June 28th. This chart is from the most recent BIS quarterly review, What we can see is that the majority of OTC interest rate derivatives are centrally cleared, and that share has been relatively stable in the last couple of years. However, a more interesting picture is perhaps the one on the right, which shows the central clearing of credit default swaps, which from a low base has been steadily increasing. Finally, I mentioned also the PFMI earlier, and as with other global standards, implementation monitoring is being carried out to promote timely, complete, and consistent adoption. CPMI and IOSCO is carrying out the implementation monitoring of the PFMI in 3 stages. Level 1, self-assessments by jurisdiction. Level 2, independent peer review of specific countries. And level 3, where we conduct an independent peer review of a range of FMIs, typically focusing on a specific aspect of the PFMIs. This figure shows a snapshot of the level 1 assessments, self-assessments, for CCPs in CPMI IOSCO member jurisdictions. Green means that self-assessment of full implementation of the PFMI. Yellow denotes broad compliance with some work to do. Red means even more work to do. And blue is non-applicable. For those with good eyes, the circles in East Asia are Hong Kong and Singapore. So as you can see, most countries have self-assessed that they have fully adopted the PFMIs. There are a few cases where implementation is not complete, but we expect these to reach green in the not too distant future. In parallel to the level 1 self-assessment, the CPMI will continue to perform more in-depth reviews, both at the country level and at the level of FMIs. This was a quick summary of a small but hopefully representative sample of the CPMI's work program. Despite the diverse range of topics, there's one key goal that underlies all the work of the CPMI, and that is financial stability. I believe a goal that we all share in this room. Thank you very much, and thank you for your attention.
Good afternoon, ladies and gentlemen, and thank you very much for the opportunity to speak to you about deposit insurance reforms and the latest developments and future work of the International Association of Deposit Insurers. For those of you who may not know us very well, IADI's mission is to contribute to the enhancement of deposit insurance systems by promoting guidance and standards and international cooperation on best practices. The cornerstone of our work are the IADI core principles for effective deposit insurance systems, which are structured in a similar way to the Basel core principles on banking supervision and other international standards. But in addition to developing these standards, we also aim to help our member deposit insurers try to improve their compliance. So we are spending an increasing amount of our resources on developing additional research and guidance and also technical assistance. Just to maybe give you a bit of a snapshot of the growth in deposit insurance systems, because it's been quite dramatic, and also in our membership. IADI was established in 2002 with 25 member deposit insurers, and since then we have grown to 83 members, but we also have a number of partners and associates. Obviously, financial crisis stimulates the development of systems, but it's also, we see a growing incorporation of deposit insurance systems because they're recognized that a well-designed deposit insurance system is a cornerstone of a good financial safety net, and it promotes financial stability. The core of our work is our core principles. They are our international standards. They're relatively new. They first came out in 2009, but they were substantially revised and updated during the 2014-16 process. The core principles deal with all aspects of a deposit insurance system, from the objectives of the system to the governance, to coverage, to funding, most importantly to payout. But deposit insurers are also involved increasingly in other sort of non-payout resolution activities like purchase and assumption. And in that regard, and with the work of the FSB, we work closely and try to incorporate our core principles and make sure that they're consistent with the work of the FSB. Since the financial crisis, we've tried to enhance the core principles in a number of areas, and the key one is funding. It is now mandatory, according to the core principles, that all deposit insurance systems have ex-ante funding. There's increasing expectations of rapid payouts, so the core principles have a 7 working day payout target, and also sufficient coverage. Well, it is true that in a crisis, blanket guarantees are often introduced. In normal times, many deposit insurance systems have insufficient coverage, and so therefore runs occur when they shouldn't. We've also worked in strengthening governance frameworks to ensure deposit insurance systems are at least operationally independent within the safety net. And crisis management. A significant amount of work has been done in terms of incorporating the deposit insurer within the financial safety net for consistent financial stability and crisis management work. Deposit insurance systems typically have deposit insurance funds, and we've seen since the crisis a growth in the development of overall resolution funds. Deposit insurers have a variety of mandates. In some jurisdictions, they're pay box, but in about 20 of our jurisdictions, they're the primary resolution authority. So key area is how do you coordinate a resolution fund with a deposit insurance fund and ensure they work together. One of our jobs is to monitor compliance amongst the various members. And what we've done here is we've sort of combined about 30 self-assessments of the core principles, along with a number of FSAPs and FSB peer review results, and sort of tried to get a picture of where the membership is in terms of its compliance. The blue and the green are good. That means you're compliant or largely compliant. But orange and red are not so good. And we look at areas where a lot of deposit insurers are going to need help in terms of bringing them up to the standards. One of them is the 7-day payout, which will be difficult in a lot of systems. And so that's sort of a key challenge. Another is funding sufficiency. Well, the majority of deposit insurers have deposit insurance funds. By a lot of measures, they are probably not adequate to deal with their needs. And in particular, this idea of backup emergency funding, if there's a wider scale of failures, and how that would be developed, coordinated with other members of the safety net. Resolution, Morten was talking about CPMI being akin to a plumbing system. Sometimes deposit insurers, we're called undertakers of the system because we deal with liquidation and payout. But there's an increasing number of deposit insurers that are being given other tools as well, such as supporting sale, merger, purchase and assumption, even a role in bail-in. So there's resurrection as well. It's not just liquidation and payouts. But that's a difficult area because of different deposit insurers have different mandates. And so in our core principles, we make direct reference to the FSB key attributes and that very full toolkit. And in that sense, some jurisdictions have quite a bit of work to do. Cross-border issues, there's an increasing issue with deposit insurance and insured deposits between jurisdictions and how coverage and how that works. So we've been trying to promote more MOUs and cross-border type agreements in the case of bank failures. IADI looking towards the future, has really three key strategic priorities. One is to promote compliance with the core principles. The second is the area of research, guidance, and policy work, which we've been trying to increase our capacity to do. And the third is to try to enhance technical assistance, since we have a number of systems that are facing considerable challenges, and we're trying to work with our other standard setters and international organizations to enhance the provision of that. And like all organizations that have grown rapidly, we are also always looking at ways of enhancing our governance and governance reform. So I would just go, because of time, I'll just go very briefly into these. In terms of promoting compliance with the core principles, we've established a number of programs. One of them is a self-assessment technical assistance program where we will organize experts in deposit insurance to help individual countries who have specific problems and issues. Usually this is requested in advance of an FSAP or some other type of review. We've done Brazil and Korea recently because this is a new program, and Vietnam is scheduled later on this year, but we have a number of jurisdictions coming on board. We're also working very, very closely with the IMF and the World Bank on their FSAP program and helping in wherever we can in terms of technical assistance. And also, we try to help as much as we can and participate in FSB programs with the resolution steering group, but also with work on implementation monitoring. And in the future, we are trying to develop a sort of high-level compliance assessment of systems, so every year we can get a better benchmark of where the membership is. We're also in the area of deposit insurance research and policy development. We've created a research unit in our secretariat just recently with 2 new hires, and that will expand our ability to examine emerging issues and develop better research. But there are a number of areas that we see as important, and we're focusing our attention on over the next 2 years to develop more guidance. One is this issue of the resolution framework and deposit insurance, the interaction of deposit insurance guarantee schemes with bail-in and with deposit insurance and resolution funds. There's great interest in determining optimal deposit insurance coverage levels and fund adequacy. As I mentioned before, looking at ways to improve the integration of the deposit insurer with other elements of the safety net in a crisis. And in the world of deposit insurance, we also look at FinTech, not so much, though, from the credit FinTech or payment FinTech process, but mobile deposits. In certain areas of the world, such as Latin America and Africa, these have become rapidly growing forms of deposits. Many of them are becoming insured. It is very difficult to insure some mobile deposits in these systems, and there is no real common standard. So that is one area that we've been getting a lot of demand to do research on and work. And lastly, in terms of enhancing our technical assistance, we've tried to tailor-make our technical assistance to particular needs of regions. In the last year, we've held technical assistance workshops in Africa, Europe, and Latin America, and the Middle East. The focus there has been on payout and funding. During the next year, we're rolling out workshops in Asia and Eurasia, and the focus there will be on resolution, and in Eurasia on Islamic deposit insurance systems, because these are actually rapidly growing. There's about 7 or 8 of them now, and there are a number on stream in the future. We work heavily with the FSI on online tutorials, and during the next year, we're working with the Financial Stability Institute on a policy implementation meeting and an annual conference coming up later on in the year, which are usually quite well attended, where we look at bank resolution, supervision, and deposit insurance issues. And finally, as we have evolved as an organization, we've just gone through a revamping of our governance framework. Essentially, that involves making our governing body function a little more like a board of directors, looking at high-level strategy and implementation rather than detailed operations. We've also trying to streamline our committee structure, moving from 7 to 4. And also the Secretary General has been tasked more with strategic planning, execution, and implementation going forward. So those are the key highlights of our reforms in the deposit insurance world and with IADI. Thank you very much.
Thank you very much, David. Thank you all the speakers for their very insightful remarks, very useful, I think, overview of the main tasks that you are undertaking now and the main challenges ahead. Thank you very much. Let me just add a couple of remarks in closing this session. I think it's quite evident from the presentations that we have listened in this session. It's clear that there has been considerable progress in improving regulation, financial regulation, and that, of course, it will have a very positive implication from the point of view of increasing the resilience of the international financial system. And I think it's very important as well to recognize this has only been possible thanks to the considerable international cooperation effort, maybe unprecedented cooperation effort has taken place. I think it's very important to stress this point. Having obviously seen that basically the core of the reforms have already been actually developed by different standard setters. Of course, there are a number of pending issues. Some of them still entail some relevant technical and political complexity. We should be aware of that. But at the same time, I think it's clear that we should expect that the standard setters will be able actually to solve those issues in the forthcoming future. I think it's also interesting to realize that now basically all the standard setters are now moving a little bit the focus from pure regulatory issues, rulemaking or standard setting, to something we have to do with implementation. And this has basically three dimensions. One is ensuring that the new standards are properly and timely adopted in different jurisdictions. Second, that there is a good analysis that the reforms, once implemented, are delivering the expected results in terms of the objectives that were previously identified. And third, to promote the adoption of sound supervisory policies that could help maximize the potential benefits of the new standards. I think that the standard setters are now paying much attention to those issues. So let me just say from the Financial Stability Institute point of view that, of course, we remain ready to cooperate with the standard setters as well as with national jurisdictions, national authorities, particularly in that new focus on policy implementation. Let me also take this opportunity to announce that as of today, we have published a new product called Executive Summaries, which is very short notes, very easy to read notes, in which we try to summarize the core of the new reforms, which have been actually approved by different standard setters. I think we are going to publish 7 executive summaries today. Of course, that number will increase in line with the work program of the different standard setters. And with this, let me just thank again all the speakers, David, Morten, Svein, Bill, and Josie, for their presence here, for their very interesting remarks in this panel. That's all, so thank you very much. I hope you are enjoying these events in Basel.